The financial world is a complex web of interconnected systems, and right now, there are some indicators flashing warning signs. One crucial element in this intricate dance is the reverse repurchase facility at the Federal Reserve. It's not just a mouthful of words, it's a big deal, and it's currently holding over $1 trillion. Picture this facility as a safety valve for the banking system. When there's excess cash floating around in banks, the reverse repurchase facility acts as a parking lot for that money. Since May 2023, though, it's been steadily drained. This isn't just a shift in numbers, it's a hint at a change in liquidity. Liquidity is like the lifeblood of the financial system. When there's enough of it, things flow smoothly. When it tightens, it's like clogging the arteries of the economy. Now, the Federal Reserve's balance sheet is giving us another piece of this puzzle. It represents the assets the Federal Reserve holds, and it's been shrinking, a phenomenon known as quantitative tightening, QT. Quantitative tightening sounds like financial jargon, but let's break it down. As the balance sheet shrinks, it sucks money out of the system. Less money floating around means less liquidity. It's like taking dollars out of your wallet. The impact? Less money to spend, invest, or lend. Speaking of money, let's talk about the total money supply. It peaked in April 2022 and has been on a downward trajectory since. Imagine it as the amount of cash available in the economy. When it's shrinking, it has implications for everything from asset prices to interest rates on loans. Asset prices are like the stock market or the value of your house. When the money supply is tight, there's less cash to chase these assets, so their prices might fall. If you're looking to buy a house or invest, it might not be the best time. On the flip side, if you've got money to lend, you might start charging higher interest rates because it's scarcer. And that brings us to the federal funds rate. It's the overnight rate at which banks trade cash and collateral. Think of it as the interest rate banks charge each other. The Federal Reserve sets upper and lower limits on this rate. When it moves, it sends ripples through the entire economy, impacting everything from mortgages to auto loans. Now, the yield curve is doing something interesting. It's currently inverted, meaning short-term government debt yields more than long-term debt. This might sound like financial wizardry, but it's essentially saying that investors are more worried about the near future than the long term. And historically, when this happens, it's been a red flag for market crashes or recessions. Imagine you're driving, and suddenly the road in front of you disappears. That's what an inverted yield curve feels like for investors, an unexpected twist that hints at trouble ahead. On the government front, there's the federal government deficit. It's the gap between what the government spends and what it collects in taxes. Right now, that deficit is 133% higher than the same period last year. It's like overspending on your credit card, but on a much larger scale. Why does this matter? Well, an increasing deficit can lead to higher interest rates. When the government borrows more, it competes with everyone else for the available money. This increased demand for borrowed money can push interest rates up, crowding out other borrowers. These seemingly abstract numbers and concepts are like warning signs on the economic dashboard. They're telling us that something is shifting in the financial landscape. It's not just about the big shots on Wall Street, it trickles down to everyone. Your mortgage rates, the value of your investments, the cost of borrowing, they're all influenced by these intricate financial moves. Now, imagine this as a giant, intricate puzzle. Each piece, the reverse repurchase facility, the Federal Reserve's balance sheet, the total money supply, the federal funds rate, and the yield curve, fits together to create a picture of our economic health. Right now, that picture is a bit fuzzy, and there's a sense of uncertainty in the air. It's not all doom and gloom, but it's a reminder that economies are delicate ecosystems. Like a spider's web, it's resilient, but it can also be fragile. These indicators aren't just for economists to ponder, they're breadcrumbs for all of us to understand where we might be headed financially. So, as these numbers and rates dance on the economic stage, it's worth paying attention. Whether you're a Wall Street pro or someone just trying to make ends meet, these signals matter. They're the whispers of the economy, and they're telling us to be alert, to be prepared, and to understand that the financial tides might be changing. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.